Welcome to the Business Short Course series presented by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. This course covers the financial statement called the cash flow statement. We will start with a quote from Robert Herjavec, whom many of you may know from the TV series Shark Tank. Cash is the lifeblood of your business. There are very few things in business that will kill you, but running out of cash is one of those things. You can recover from almost any other mistake, but if you run out of cash, you're dead. The cash flow statement, as the name implies, tracks the inflow and outflow of a company's cash. The cash flow statement measures how well a company generates cash to pay its debt obligations and fund expenses. There are three major subsections within a cash flow statement. The first is called cash flows from operating activities, the next is cash flows from investing activities, and the final section is cash flows from financing activities. The first section shown on a cash flow statement is cash flows from operating activities. This section lists and totals all sources and uses of cash from a company's operations, including net income, changes in working capital such as changes in receivables, payables, and inventory, changes in non-cash items like depreciation or deferred income tax, all other changes in net cash used in operating activities, and finally the total net cash provided by operating activities is shown at the bottom of the section. The next section shown on a cash flow statement is cash flows from investing activities. This section lists and totals all sources and uses of cash from a company's investments, including the purchase of property, plant, and equipment, which are cash outflows for buying new machinery, buildings, or equipment, the sale of property, plant, and equipment, which are cash inflows from selling old machinery, buildings, or equipment, the purchase or sale of investments, which are cash outflows and inflows from buying and selling stocks, bonds, or other investments, cash loaned to other entities, which are cash outflows for lending money to other companies, the collection of loans, which are cash inflows from the repayment of loans made to others. As in the operating activities section, the total net cash used in investing activities is shown at the bottom of the section. The final section is cash flows from financing activities. This section lists and totals all sources of cash from investors and banks and the way cash is paid to shareholders. This includes cash inflows from issuing bonds or taking out loans, the repayment of debt, which are cash outflows for repaying loans or bonds, dividends paid, which are cash outflows for paying dividends to shareholders or owners, the repurchase of stock, which are cash outflows for buying back the company's own shares, and as with the other two sections, the net cash from financing activities is shown at the bottom of the section. Now that we've discussed the three sections of the cash flow statement individually, operating, investing, and financing activities, let's put it all together with an example. This is the statement of cash flows for Good Eats Restaurant and Catering for the year ended December 31st, 2024. First, you list the cash at the beginning of the period, in this case the beginning of the 2024 calendar year. Then you list the cash flows from operating, investing, and financing activities in order with subtotals. After that, you calculate the net increase or decrease in cash from these three activities. Finally, you add the net increase in cash to the cash at the beginning of the year to find the total cash at the end of the year. For a small business, the ability to see if there's going to be enough cash to pay bills is critical. Even if a business owner does not use an actual cash flow statement, they will always have the need to track cash coming in and out. Businesses in certain industries might see large amounts of cash going out to pay for expenses, but may not receive cash payment for the goods or services for weeks, months, or even years. One example of this is raising beef cattle. A business might require a large upfront investment to purchase and raise bottle calves, but that calf will not be ready for slaughter until it is 18 to 24 months old. The liquidity assessment for a small business is paramount, even if the business is not using an official cash flow statement. Time for a pop quiz. Question 1. Which of the following sections are not part of the cash flow statement? A. Revenue activities, B. Investing activities, C. Financing activities, or D. Operating activities? Question 2. What does the cash flow statement show? A. Company profits, B. Company cash inflows and outflows, C. Company debts, or D. Company assets? Question 3. Which section of the cash flow statement includes money spent on buying equipment? A. Operating activities, B. Investing activities, C. Financing activities, or D. Marketing activities? If you need extra time to determine each answer, feel free to pause the video now. We will show the answers in just a few seconds. Here are the answers. Which of the following sections are not part of the cash flow statement? The answer is A. Revenue activities are part of the income statement, not the cash flow statement. What does the cash flow statement show? The answer is B. The cash flow statement shows company cash inflows and outflows. And question 3, which section of the cash flow statement includes money spent on buying equipment? The answer is B. Investing activities. Using the partial cash flow statement, calculate the increase in payables, the net cash used in investing activities, the net owner distributions, the net increase in cash, and the cash at the end of the year. And if anyone is unaware, in accounting, negative numbers are shown using parentheses. There's a PDF of this practice problem available for download at the website should you wish to solve it by hand. Solutions. The increase in payables is $3,400. This is calculated by taking the net cash provided by operating activities and subtracting the other cash flows from operating activities. The net cash used in investing activities is $25,500, written as a negative because it is a decrease to cash. This is because it is the sum of the $15,500 in net cash used for equipment and the purchase of a CD for $10,000. The net owner distributions is calculated by taking the net cash from financing activities and subtracting the net cash from borrowing activities. This gives a value of negative $5,000. Again, this value is negative because owner distributions decrease the cash available to a company. To calculate the net increase in cash, you must add the net cash provided by all three types of activities: operating, investing, and financing. The total of these three values is $24,600. Finally, to calculate the cash at the end of the year, you take the net increase in cash and add in the cash from the beginning of the year for a total of $32,100. In summary, the cash flow statement is a crucial financial document that provides insights into a company's cash inflows and outflows over a specific period of time. The importance of the cash flow statement lies in its ability to help business owners and managers understand the availability of cash. Used properly, a company's cash position can help a business grow and flourish. If ignored, improper cash flow can make all other efforts in business futile. Thank you for listening to this presentation brought to you by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. This institution is an equal opportunity provider.